Imagine waking up one morning to find out your bank is bankrupt. Your paycheck is frozen. Your savings are inaccessible. ATMs work, or they don't. Then, before panic fully sets in, the government steps in and says, "This institution is too big to fail." Money appears. Losses are absorbed. The bank survives. Here's the uncomfortable truth. That decision wasn't made in that moment. It was made years earlier, quietly, mathematically, and not by the people you think. And right now, that same decision is being made again. This matters now because the global financial system is more concentrated than it has ever been. Fewer banks, bigger balance sheets, more leverage, more interconnected risk. When something breaks, it doesn't break alone anymore. And when failure becomes dangerous enough, failure stops being allowed. So, who decides what is too big to fail? Let's start with what that phrase actually means. Too big to fail doesn't mean a company is important. It doesn't mean it's well run. It doesn't even mean it's profitable. It means that letting it fail would cause damage beyond itself. Damage to payment systems, damage to credit markets, damage to confidence. And confidence in finance is oxygen. Without it, everything suffocates at once. The idea entered public consciousness in 2008, but the logic is much older. Banks don't just hold money, they are the plumbing of the economy. They clear transactions, they extend credit, they connect savers to borrowers. If one large bank fails, other banks suddenly don't know who is solvent. Lending freezes, liquidity disappears. That's how a private failure becomes a public emergency. But here's where it gets uncomfortable. There is no official list of too big to fail institutions, no formal vote, no press conference in advance. Instead, the system works backward. Regulators ask a simple question in a crisis. If this fails, what breaks next? That's it. And the answer is usually not theoretical, it's mathematical. Balance sheets are stacked on top of each other like dominoes. Bank A lends to Bank B. Bank B insures Bank C. Bank C clears trades for pension funds. Pension funds support retirees. So when one domino wobbles, the fear isn't its collapse, it's the chain reaction. This is why size alone isn't the deciding factor. Interconnection matters more. A mid-sized institution that sits at the center of critical markets can be more dangerous than a massive one but isolated. This is how firms most people have never heard of suddenly become systemically important. And here's the irony. The more dangerous an institution becomes to the system, the safer it becomes to itself. Because markets know something governments rarely say out loud. In a crisis, the biggest nodes get rescued. That expectation changes behavior. If you believe failure will be absorbed by someone else, you take more risk. Not recklessly, rationally. This isn't greed, it's incentives. And the math is brutal. Let's say a bank makes a risky bet. If it works, shareholders win. Executives get bonuses. Market share grows. If it fails, losses don't stop at zero. They spill outward, into depositors, into counterparties, into the economy. At a certain scale, those losses exceed what the system is willing to tolerate. That's the moment the state steps in. Not out of generosity, out of containment. Publicly, this is framed as stability. Privately, it's damage control. During the 2008 crisis, this logic played out in real time. Lehman Brothers was allowed to fail, not because it was small, but because regulators believed they could manage the fallout. They were wrong. Money markets froze, credit seized, trust evaporated. Within days, the rules changed. AIG was rescued, Citigroup was rescued. Banks far larger and more complex were saved because the cost of letting them fall had become unthinkable. That moment quietly rewrote global finance. Afterward, regulators promised never again. New rules were introduced, higher capital requirements, stress tests, resolution plans. On paper, no bank would ever be too big to fail again. In reality, something else happened.
The biggest institutions became even bigger. Mergers accelerated. Compliance costs crushed smaller competitors. Market share concentrated. Today, a handful of financial institutions dominate global capital flows, and they are more intertwined than before. So, who actually decides? Technically, it's regulators, central banks, treasuries, supervisory agencies. But functionally, the decision emerges from markets themselves, from how much exposure exists, from how fast panic spreads, from how costly uncertainty becomes. By the time officials step in, the verdict has already been delivered. This is where public perception and reality split. The public imagines backroom deals and political favoritism, and sometimes that exists, but more often, the decision is colder than that. It's arithmetic under pressure. How many payrolls fail if this collapses? How many funds break the buck? How many markets stop clearing tomorrow morning? At a certain threshold, intervention isn't debated, it's assumed, and that assumption reshapes the entire system. Investors price it in, creditors relax, risk migrates upward. This creates a quiet feedback loop. The institutions most likely to be rescued attract the cheapest funding. Cheaper funding allows them to grow larger. Larger size increases their systemic importance, which makes rescue even more likely. Too big to fail isn't declared, it's grown into. And here's the uncomfortable math. Losses from rescues don't disappear, they move onto central bank balance sheets, onto government debt, onto currency stability. The cost isn't paid immediately, it's diffused through time, through inflation, through lower returns, through higher taxes. Most people never see a bill labeled bank bailout, they feel it indirectly. That's why the debate never fully ends. Supporters argue that bailouts prevent collapse. Critics argue they entrench power. Both are correct. The system trades short-term stability for long-term distortion, and the distortion compounds. The more often rescues occur, the more normalized they become. What was once extraordinary becomes expected, and expectations are powerful. Today, when markets wobble, traders don't ask, will authorities intervene? They ask, how fast? This is why crises feel different now, less chaotic, more managed, but also more fragile. Because when stability is guaranteed, risk doesn't vanish, it hides, in leverage, in derivatives, in places regulators aren't watching yet. The real danger of too big to fail isn't the bailout itself, it's what happens between bailouts, the slow accumulation of invisible risk. So, who decides what is too big to fail? Not voters, not headlines, not even politicians in the moment. The decision is made by scale, by structure, by interconnectedness, by a system that can't afford to test its own limits. And that leads to the final, unresolved question. If institutions become too big to fail because the system can't survive their failure, at what point does the system itself become too big to save?